I am Peter Joubert from Imali Pro. We specialize in forex trading, intermarket analysis and money flow. This is the first video in a series on trading psychology. We will explore some of the foundation aspects of trading psychology. In future articles, we will examine the psychology and techniques necessary to be profitable and successful. 85% of trader accounts are in a loss position. The majority of people doing well in other occupations fail as traders. Many traders who fail at trading have excuses for why they're not making money. Those excuses have to do with the external environment and circumstances. They would say, the market is very erratic at the moment. Trump's tweets are causing havoc in the markets. I don't have enough time for proper analysis. I must find consistency in the markets, and so we can go on. Most traders who fail usually take inappropriate action to remedy the situation. One of the first actions is to get more knowledge and gather more information about the markets. The market is this big thing that you must beat. If I could only read the market better, I can tell you with confidence that you can't beat the market. No matter your level of knowledge and skills, there is too much volatility and randomness. The reality of trading is that many profitable traders can lose and will lose approximately 50% of the time and still make money. Losing is a problem. As humans, we have a problem losing and being wrong. It's contradictory to our upbringing. In school, sport and social activities, parents and tutors expect and teach children to win, sometimes at great cost. Losing is not an option. A casino is a very profitable business, but they don't mind losing. The house edge on the 00 roulette wheel is 5.26%. which means that the casino makes money by just winning 52.63% of the time and losing 47.37% of the time. This is part of their business model. Many traders are devastated when they lose and find themselves on the wrong side of the market. Most traders are obsessed with winning trades. A failed trader's remedial action is usually of little value. After a series of losses and big drawdown, a trader studies to get more clever about trading and develop new systems just to fail again. You see, the problem is not a lack of knowledge and expertise, but something else. The trader himself is 90% of the problem. A trader must be able to handle a loss ratio of approximately 50% and remain calm and collected. I will tell you later how to lose 50% of the time and still be profitable. The million-dollar question is, can trading be mastered? Mark Douglas, writer of Trading in the Zone, a person who helped thousands of traders to be profitable over many years, is well qualified to give us a good answer. I quote him, "For those who have learned how to be consistent or have broken into what I call the threshold of consistency, the money is not only within their grasp, they can take it at will." I'm sure that some will find this statement shocking or difficult to believe, but it's true. There are some limitations, but for most part, money flows into the account of these traders with much ease and effortlessness that it boggles most people's mind. End of the quote. There are recurring patterns in the markets. Winning traders identify patterns that they can trade and then, based on probability, put on trades with a good chance of making a profit for them. The secret is that when you win, it must be 1.5 to 3 times more than when you lose. To achieve this, you must have the right trade plan for you that you execute flawless. The easiest way would be to use a simple checklist to put matters right in your trading. Unfortunately, it's not that simple. Most often, success doesn't come easy. There's no surefire way to be successful. But taking responsibility for your actions is a vital step. Every thought has a hidden frame behind it based on your underlying beliefs, values, and assumptions. Your mind is very powerful. Your thoughts are a catalyst for self-perpetuating cycles. What you think influences how you feel and how you behave. If you think you're a failure, you'll feel like a failure and you'll act like a failure, which reinforces your beliefs that you are a failure. The way you think about yourself turns into your reality. If you draw inaccurate conclusions about who you are and what you're capable of doing, you limit your potential. Once you draw a conclusion about yourself, you're likely to do two things. Look for evidence that reinforces your belief and discount anything that runs contrary to your belief. Someone who develops the belief that he's a failure, for example, will view each mistake as proof that he's not good enough. When he does succeed at something, he'll chalk it up to luck. Consider for a minute that it might not be your lack of talent or lack of skills that are holding you back. Instead, it might be your beliefs that keep you from performing at your peak. Creating a more positive outlook can lead to better outcomes. That's not to say positive thoughts have magical powers. Positive thoughts lead to productive behavior, which increases your chances of successful outcomes. Take a look at the labels you've placed on yourself. Maybe you declared yourself an incompetent trader. Remind yourself that you don't have to allow those beliefs to restrict your potential. Just because you think something doesn't make it true. The good news is you can change how you think, you can alter your perception and change your life. Here are two ways to challenge your beliefs. The first one, look for evidence to the contrary. Recall incidences when your beliefs weren't reinforced. Acknowledging acceptance to the rule will remind you that your belief isn't always true. The second way, challenge your beliefs. Do things that test how true your beliefs are. If you think you're not good enough, do something that helps you to feel worthy. Do a market analysis yourself before looking at the expert analysis. Success doesn't come easy. There's no surefire way to be successful, but I'm sure that no one ever became a success without taking responsibility for their actions. Taking responsibility means acknowledging and accepting at the deepest part of your being that you, not the market, are completely responsible for your success or failure as a trader. Taking responsibility means believing that all of your outcomes are self-generated, that your results are based on your interpretations of market information, the decisions you make, and the actions you take as a result. There are circumstances that happen outside the scope of your control, but how you react to them is important. You have control over your emotions, reactions, and decisions. Taking anything less than complete responsibility sets up two major psychological obstacles that will block your success. You will establish an adversarial relationship with the market that takes you out of the constant flow of opportunities. Second, you will mislead yourself into believing that your trading problems and lack of success can be rectified through market analysis. When you project any degree of responsibility onto the market for giving you money or cutting your losses, the market can all too easily turn into an adversary or enemy. Consider the fact that the market presents its information from a neutral's perspective. That means the market doesn't know what you want or expect, nor does it care. From the market's perspective, each moment is neutral. To you, the observer, every moment and price change can have meaning. But where does the meaning exist? The meanings are based on your experience and exist in your mind, not in the market. You must get into the market flow to take advantage of the endless stream of opportunities to enter and exit trades without self-criticism or regret. When you will be in the best frame of mind to act in your own best interest and learn from your experiences. The point I'm making is that winning in any endeavor is mostly a function of attitude. Many people are certainly aware of this, but at the same time, most people don't understand the significant part attitude plays in their result. If you want to change your experience of the markets from fearful to confident, if you want to change your result from an erratic equity curve to a steady and rising one, the first step is to embrace the responsibility and stop expecting the market to give you anything or do anything for you. The best traders think in unique ways. They have acquired a mental structure that allows them to trade without fear and at the same time keeps them from becoming reckless. If we start from the premise that to create consistency, traders must focus their efforts on developing a successful trader's mindset, the consistency you seek is in your mind, not in the markets. Putting on a few or more winning trades does not mean that you have become a successful trader. That's the way it feels, because it taps into a state of mind that only the most accomplished people experience on a consistent basis. Losing and being wrong are inevitable realities of trading. Successful traders operate out of a belief that there is no possible way to avoid a loss, because losing is a natural consequence of trading. After a loss, many traders are in a state of emotional pain. Even though most people who trade consider themselves responsible adults, only the very best traders have reached a point where they can and do accept complete responsibility for the outcome of any particular trade. When you put on a trade, it is in anticipation of making money. Every other trader in the world who puts on a trade does so for the same reason. When you look at your relationship with the market from this perspective, you could say that your purpose is to extract money from the markets. But by the same token, the market's sole purpose is to extract money or opportunity from you. Accepting the risk means accepting the consequences of your trades without emotional discomfort or fear. This means that you must learn how to think about trading and your relationship with the markets in such a way that the possibility of being wrong, losing, missing out, or leaving money on the table doesn't cause your mental defense mechanisms to kick in and take you out of the opportunity flow. If you are afraid of the consequences, you should not trade. The fears will act in such a way on your mental setup that the things that you're trying to avoid will happen to you. Struggle, trying, or fear associated with trading will take you out of the present moment and flow, and therefore diminish your results. We have discussed some issues and shared important information regarding trading psychology. Armed with some information and the intention to improve is not enough. You must have a plan that you update as you develop as a trader. A person going on a journey needs a road map. As a trader, you need trading strategy and a trading plan. A trading strategy is the method of buying and selling into markets that is based on predefined rules and used to make trading decisions. A trading strategy includes a well-considered investing and trading plan that specifies investing objectives, risk tolerance, time horizon, and tax implications. In the next video, we will discuss how to develop a trading strategy and plan.